Here's something nobody tells you about your Roth IRA. Most people are putting the right investments in the wrong place. And that one mistake, that one quiet, invisible mistake, could cost you hundreds of thousands of dollars in tax-free retirement wealth. Now here is what makes this so frustrating. It is not that people are picking bad investments. They're actually picking some of the most popular, most trusted funds on the planet. Funds that millions of Americans hold in their retirement accounts. But placing the wrong fund in your Roth IRA is like putting diesel fuel in a gasoline engine. The fuel is not bad, the car is not bad. The problem is the mismatch. In this video, I'm going to show you the 4 best ETFs to buy and hold inside your Roth IRA, and I mean hold forever. I'll also show you which popular funds to move out of your Roth and exactly where they belong instead. By the end of this video, you will know how to set up your Roth IRA in a way that most financial advisors never explain clearly. This is not complicated, and you do not need a finance degree to understand it. You just need about 12 minutes. Let's go. Lesson number 1. Why the Roth IRA is the most powerful account you own. Before we talk about which ETFs to buy, you need to understand why the Roth IRA is different from every other account you own. Because once you understand this, every single recommendation I make today will make perfect sense. Here's how a Roth IRA works in plain language. You earn money, you pay your normal taxes on it, then you put up to $7,500 of that already taxed money into your Roth IRA each year. If you're 50 or older, that number goes up to $8,600 in 2026. And here's where the magic happens. From that moment forward, every dollar of growth inside your Roth IRA is yours, tax-free, forever. When your investments go up in value, no tax. When you collect dividends, no tax. When you retire and pull that money out, no tax. Not less tax, zero tax. Now think about what that means for a second. If you invest $7,000 a year starting at age 45 and your Roth grows at around 12% per year for 20 years, which growth ETFs have historically done, you could have over $500,000 sitting in that account. And every single penny of that, the original $7,000 a year you put in, and every dollar of growth on top, belongs to you, completely tax-free when you retire. That's why this account is so powerful, and that's exactly why what you put inside it matters so much. The whole point of a Roth IRA is to let your money grow as large as possible, tax-free, for as long as possible. So logic tells us this: the assets with the highest growth potential belong in here. But here's where most people go wrong. Lesson number 2. The rule most people get backwards. There's a concept in investing called asset location. Most people have never heard of it, but it may be the single most valuable idea in this entire video. Asset location is not about what you invest in. It's about where you hold each investment. Think of it this way. You have a few different accounts, maybe a Roth IRA, a traditional IRA or 401k, and a regular brokerage account. Every account has different tax rules, and because of those different rules, certain types of investments perform better in certain accounts. Morningstar, Vanguard, Charles Schwab, and JP Morgan have all studied this, and the research is clear. Putting the right investment in the right account can add anywhere from 0.14 to over 1% of extra return every single year without changing a single investment you own. On a retirement account worth $500,000, that's thousands of dollars every year just from placing your funds correctly. Now, here's the part that's going to surprise a lot of you. Some of the most popular ETFs that people proudly put in their Roth IRA, like SCHD, VNQ, and BND, are actually better held somewhere else. Those are great funds, but the Roth is the wrong home for them. I'll explain exactly why and where they belong instead a little later in this video. First, let me show you the 4 best ETFs that are perfectly built for a Roth IRA, starting with the one every single Roth IRA should have.
ETF number 1 is VOO, the Vanguard S&P 500 ETF. This is the foundation. This is the anchor. Every Roth IRA should have this, or something very close to it. What does VOO actually own? It owns a tiny piece of 500 of the biggest, most established companies in America. Apple, Microsoft, Amazon, Google, NVIDIA, Johnson & Johnson, Visa, Walmart, all of them in one single fund. And here's the part that should make you stop and think for a second. This fund, which owns 500 companies across every major industry in the American economy, costs you almost nothing to hold. Just 3 cents for every $100 you invest, per year. Now, why does VOO belong in a Roth IRA specifically? 2 reasons. First, VOO barely pays dividends. Its dividend yield is just about 1%. That means nearly all of your returns come as price growth, not income, which compounds perfectly inside a tax-free account. Second, the long-term track record speaks for itself. $10,000 invested in VOO 10 years ago would be worth roughly $40,000 today. Inside a Roth IRA, every dollar of that $30,000 gain belongs to you, tax-free. Now, if you prefer a fund that owns not just 500 companies, but the entire U.S. stock market, over 3,500 companies, then VTI, the Vanguard Total Stock Market ETF, is an equally excellent choice. Same tiny fee, similar returns, just broader. Both VOO and VTI work perfectly here. I just want you to have one of them as your foundation. ETF number 2 is where the Roth IRA starts to become something special. This is the growth engine, and the 2 best options here are VUG, that is the Vanguard Growth ETF, and SCHG, the Schwab U.S. Large Cap Growth ETF. Now, you might ask, what makes a growth ETF different from the S&P 500? Great question. A growth ETF takes things a step further. Instead of owning all 500 companies in the S&P 500, it focuses specifically on the companies that analysts and index methodologies believe will grow the fastest. Think technology, AI, innovation, the companies that are building the future. Here's the data. Over the past 10 years, VUG has returned around 18% per year. SCHG has returned around 19% per year. Compare that to a bond fund sitting in a Roth IRA returning 2% per year over the same period. $10,000 in a bond fund inside your Roth for 10 years, roughly $12,000. $10,000 in VUG inside your Roth for 10 years, over $50,000. And here's the key insight. Every single dollar of that $50,000 belongs to you, permanently tax-free. Now, here's why growth ETFs are the perfect fit for a Roth IRA specifically. VUG's dividend yield, just 0.4%. SCHG, even lower. Nearly all of your return is pure price appreciation, no taxable dividends, no income to shelter, just compounding growth, tax-free, forever. Think of it like planting a seed. A dividend fund sends you little fruit every quarter. That's nice, but a growth ETF just grows the tree, bigger and bigger and bigger, and inside a Roth, you never pay a penny of tax when you finally harvest it. Either fund works. VUG has over $200 billion in assets. SCHG is slightly more concentrated in fewer, higher conviction names. Personal preference separates them. Their performance does not. Now we have 2 ETFs down, 2 more to go. And I want to tell you, the next one is going to challenge something you probably believe about international investing. I already know what some of you are thinking right now. International stocks? Those things have been terrible for years. Why would I put them in my Roth? And honestly, for a long time, that thinking was completely fair. International stocks spent more than a decade underperforming U.S. markets. But here's what happened in 2025. International stocks came roaring back, and they didn't just catch up to the S&P 500, they left it behind. VXUS, the Vanguard Total International Stock ETF, returned approximately 36% over the past 12 months. The S&P 500 returned around 16%. European markets are at all-time highs. Germany announced $500 billion in infrastructure investment. Record levels of investor capital, roughly $10 billion a week, flowed into European stocks in early 2026. Now, here's the more important question for the long term. Why should any of this continue? Because of valuation, pure and simple. Right now, U.S. stocks are trading at a forward price-to-earnings ratio of about 22 times expected earnings. International stocks, closer to 14 times. That's U.S. stocks priced at roughly 40% more than international stocks for $1 of earnings. Fidelity's research team puts it simply. After underperforming for 15 to 20 years, the rest of the world is still meaningfully undervalued. VXUS gives you exposure to over 8,700 companies across developed markets like Germany, Japan, and the UK, and emerging markets like India, Brazil, and South Korea, all in one fund at just 5 cents per $100 invested per year. And because the Roth IRA shields future gains from taxes, if international stocks outperform U.S. markets over the next decade, every dollar of that outperformance is permanently in your pocket. You're not betting on one country, you're owning the world.
ETF number 4 is QQQM, and most people have not heard of this one, which is exactly why I want to talk about it. You have probably heard of QQQ, the massive, famous NASDAQ 100 ETF that tracks the 100 largest non-financial companies on the NASDAQ exchange. QQQM tracks the identical index, the exact same 100 companies, the exact same performance. The only difference is the price. QQQ charges 0.2% per year. QQQM charges 0.15% per year. That difference is small today, but compounded over 20 or 30 years inside a Roth IRA, it adds up to thousands of dollars staying in your account instead of going to fees. QQQ was designed for institutional traders who buy and sell constantly. QQQM was specifically built for long-term investors like us. The NASDAQ 100 is home to the companies driving artificial intelligence: NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta. Bloomberg calls AI the defining investment theme heading into 2026. The global AI market is projected to grow from $184 billion today to over $800 billion by 2030. You do not need to predict the future to benefit from this. You just need to own a diversified piece of the companies building it and let your Roth IRA shield every dollar of that growth from taxes for the rest of your life. Lesson number 3, the ETFs you should move out of your Roth: SCHD, VNQ, and BND. Now, I want to talk about 3 funds that are genuinely excellent, but genuinely wrong for a Roth IRA. If you currently hold SCHD, VNQ, or BND inside your Roth, this section is for you. Let me start with SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is one of the most beloved funds in the personal finance community, and for good reason. It pays a dividend yield of around 3.5% to 4%. It has delivered solid 10-year returns. It is a fantastic fund. But here's the problem with holding it in a Roth. A Roth IRA is designed to shelter your biggest gains from taxes forever. SCHB's returns are heavily driven by income, dividends paid out 4 times a year. You're using your most valuable tax shelter to protect regular income payments, when you could be using that same shelter to protect compounding price growth that is orders of magnitude larger. SCHD belongs in your traditional IRA or your 401k. Hold it there, let the dividends compound tax-deferred. Your Roth is for the growth engine. Next, VNQ, the Vanguard Real Estate ETF. REITs, or real estate investment trusts, are required by law to pay out at least 90% of their taxable income as dividends. That creates a beautiful income stream, but those dividends are taxed as ordinary income at rates as high as 37%. Traditional IRA or 401k, the dividends compound tax-deferred. Perfect. Roth IRA, yes, the dividends grow tax-free, but VNQ has only returned around 6% annualized over the past 10 years, meaning you're using Roth space to shelter modest returns when you could be sheltering much larger growth. And finally, BND, the Vanguard Total Bond Market ETF. Bonds belong in a Roth in only one scenario: when you're very close to or in retirement and need stability over growth. For everyone else in the building phase, BND returned around 2% annualized over the past 10 years. After inflation, that's basically nothing. Your Roth IRA is not a savings account. Do not treat it like one. Hold BND in your traditional IRA or 401k, where the interest income is tax-deferred. Save your Roth for investments that will truly grow. Lesson number 4, how to put it all together by age. Let me quickly show you how to combine these 4 ETFs based on where you are in life. If you're 35 to 45, you're in your building years. You have time on your side. Hold roughly 50% in VOO as your foundation, 20% in VUG or SCHG for growth, 20% in VXUS for global diversification, and 10% in QQQM for the technology accelerator. No bonds in the Roth. Keep BND in your traditional account. If you're 45 to 55, you're mid-career. Same 4 ETFs, just slightly more conservative. Consider 45% VOO, 15% VUG or SCHG, 20% VXUS, 10% QQQM, and start adding 10% in bonds, but ideally in your traditional account, not this one. If you're 55 to 65 or approaching retirement, your Roth IRA still doesn't have required minimum distributions, which means it can keep compounding for decades. You can afford to stay mostly in equities here, something like 40% VOO, 10% growth ETF, 15% VXUS, 10% QQQM, and 25% bonds. The key idea across all 3 stages is this: your Roth IRA should always lean heavily towards growth because it's the one account that can compound tax-free for the rest of your life. The one decision that changes everything. Here's what I want you to take away from this video. Investing isn't just about picking the right fund. It's about putting the right fund in the right account. And the people who understand that, the people who think about where they hold each investment, not just what they hold, those are the investors who retire with significantly more money than everyone else. You now know the 4 ETFs that belong in your Roth IRA. VOO for the foundation, VUG or SCHG for the growth engine, VXUS for owning the world at a 40% valuation discount, and QQQM to capture the AI-driven technology era at the lower cost built for long-term holders like you. You also know that SCHD, VNQ, and BND are not bad funds. They just belong in a different account. Treat them well. Put them in the right home. Now, I have a question for you. Which of these 4 ETFs is already in your Roth IRA, and which ones surprised you the most today? Drop your answer in the comments. I read every single one. And if you want to go even deeper, the next video is going to show you exactly how to build the ultimate 3 ETF retirement portfolio for every stage of life. That one's waiting for you right now. I'll see you there.